Germany just dropped a terrifying warning on the world. Could this be the precursor to an unprecedented global crisis? I'm going to make the case of why it can. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, in a stunning turn of events, Germany has issued a warning that could spell disaster for nations everywhere. You're not going to believe what just happened in Germany and what's coming to the rest of the world. Plus, while the markets tumbled on Friday, our trading strategy soared. Stay tuned to the end of the show to see how we've transformed the game when it comes to trading momentum signals and are turning this into explosive profits for our subscribers. Now let's head over to S&P Global, where we picked today's story up as German growth ticks higher as a drag from manufacturing eases. And on the headline, you might think, wow, that means things are turning around in Germany. I'm going to show you why that this is merely a plateau and what is going to be another big move down for the German economy. We've already talked about how their manufacturing sector is in a depression. Many say it can't get worse. I'm going to show you why it can, and then how what's happening in Germany is spreading all across the Eurozone and has already started to hit American workers. It's going to get worse, my friends, because let's talk about the services sector. It just hit a 2-month low. It came in at 52.2 for February, denoting a slight expansion. Now keep in mind, anything above 50 means an expansion, but it came in at a slower pace than January. Now, many people said that the service sector around the world was going to pull the manufacturing sector out of a slump because during the pandemic, people took their money and they bought goods, and now they want services, they want experiences. We said that's not how it works because the manufacturing sector drives a lot of business to the services sector. So where manufacturing goes, services follows, and that's what we're starting to see, because in Germany, while we see a 24-month high in the manufacturing sector, it's still contracted now at 46.1. That is an improvement over 45 in January, but still, I'm going to show you why it's getting worse, and what's happening in Germany is quickly spreading across the Eurozone and going to hit the United States. And underlying demand for goods and services showed signs of stabilizing at the midway point in the first quarter, with total new business recording only a modest decrease that was the weakest in the current 9-month sequence in contraction. So what everyone's hoping for and what everyone's been believing is that perhaps we're seeing a plateau. And in a move down, you tend to see plateaus. Things don't just go down in a straight line. The problem here is this plateau is going to lead to another big move down in the German economy, particularly the manufacturing sector, and it's going to pull that services sector from that slight expansion into a big contraction. Let's make the case. The lack of new business to replace completed projects meant the backlogs of work continue to fall during February, thereby stretching the current period of decline beyond 2.5 years. And this is a huge problem. They've been seeing backlogs continue to decline, and at some point, these backlogs are going to go to zero. And the issue here is there isn't enough new business to keep the workers busy. So without backlogs to keep them busy, what's going to happen is you're going to find out that hours worked for a lot of German workers are going to get cut. Many of them also going to find the unemployment line, and that's how you know you're going to see another big leg in their economy go down, because new business is not flowing nowhere near where they want it. But how does this translate to the employment side? Well, services firm nevertheless reported a rise in workforce numbers for the second month running, but keep in mind the services sector employees make far less than manufacturing employees on average. But that latest increase was only modest and offset by deeper job cuts in the manufacturing sector, leading to an overall employment to decrease at a slightly faster rate in January. So as these high-paid manufacturing jobs go away, it's going to backfeed into the economy. And let's take a look at this next chart. This is some U.S. We're going to turn to the Philly Fed manufacturing survey. That's shown in blue against continued unemployment claims in red. So while the experts are hoping that the worst now is behind the German manufacturing sector, as workers lose their jobs, it's going to get worse. And the evidence is clear. We've had data all the way back to the 1960s. As you see new orders decelerate, what happens? The continued claims rise because the manufacturers need fewer workers, so they send people to the unemployment line, and then it backfeeds. As more people get on unemployment, well, demand goes down, and you could see that happen again in the mid-70s, in the late 70s into the early 80s. You can see it happen in the mid-1980s, and again in the late 80s going into the 91 recession. It happens in the mid-1990s, and again going into the dot-com bubble. You see this very clear deceleration, then contraction of new orders, and continued claims claims surge. We see it happen going into the global financial crisis. And while right now we see the Philly Fed report a big surge last month in new orders, that pulled back this month. And what we're seeing is continued claims didn't go down. And that's the key. We would need to see them go down to tell us the economy's turning around. But what we're finding out from the manufacturing sector is they don't believe that this is sustainable. And if they don't believe it's sustainable, well, their labor force isn't either. And high labor costs were a key factor behind the sustained sharp rise in services input prices in February. And what have we been hearing from service providers all around the world? They're saying, look, we have to give our employees a wage increase, but we can't afford to absorb it. We're passing it along to you. That means services prices are going to head higher. What's going to happen to demand? Well, likely to head much lower. And the overall rate of output price inflation, this is coming out of the factory, likewise ticked down from its recent high seen at the start of the year, although it remained above the series long-run average. And what's happening here is you're seeing a problem in manufacturing. You're seeing too many goods hitting the market. You're seeing consumers can't afford them, and that's going to eventually lead to lower prices and perhaps outright deflation. I'm going to make the case of why that is. But before that, we should take a look, because many of you have probably been wondering, did our Brazil trade take a big hit? Well, no, we're still up a whopping 8.2% after Friday's big plunge in the market. Now, keep in mind, we give everyone the full reports, but here's the notes. We told them back on the 16th to buy this thing at open. As it turns out, Bank of America says this is one of the hottest sectors. But if you're wondering how we came through yesterday, well, here's the deal. We saw 2 of our trades stop out at a loss, 1 trade stop out at a gain. But look at our CTI Timer Pro, the trades against the machines. 10 of our 11 trades are up going into Monday. How about Momentum Timer Pro? 12 of our 13 trades are up. How about that? I'm going to show you why we change the game when it comes to trading. Many people trade at the top and look to go higher. We look for things that are undervalued and about to soar. Check out those links in the description and grab those coupon codes for a 30-day free trial. We're going to change your trading game in a big way, because let's talk about why prices are going to come down, why we're seeing the output prices in Germany start to cool off, because a lot of people say that's not going to happen, but the data suggests otherwise. Let's take a look at consumer prices. This shown in red against real retail sales. That's still in blue, both on a year-over-year rate of change. And we can see in the late 1980s what happened. Inflation rose, peaked out, and then we got disinflation. Why? Because retail sales declined. I'm going to show you very clearly why this happens, why they're being forced to lower prices. But let's look at what we see going in the global financial crisis. The CPI surges higher, real retail sales fall. Now, we know that wage increases were not keeping pace, and that's a big factor here. But let's take a look at where we're at now, because what do we see? 3 years of nearly negative real retail sales, and this is something that businesses want to see change in a big way. They need to see demand go up, but we're expecting inflation to rise in the months to come, and then it's going to come crumbling down. And here's the reason why, because let's take a look at retailers' inventories against the consumer price index. And what do we see going into the dot-com bubble is inflation rising right along with retailer inventories. And what happens during the recession is retailer inventories come down. And how is that possible if people are on unemployment? You've got to cut your prices. This is how you get disinflation. Let's move forward to the global financial crisis. What do we see? Inflation surging. Retail inventories start to peak. And when they peak, what are they doing? They're cutting back on their new orders. When they cut back on their new orders, you cut back on labor demand as well. You go right into a global financial crisis. And then look, inventories come down because we get deflation. You've seen they have to cut their prices to move that inventory off the shelves. And look where we're at now. We have a massive buildup in inventory. What are we expecting? Inflation to rise, at least in the short term. And then what's going to happen? It's going to come down. You're going to see retailers need to clear their inventory. There's only going to be one answer, and that is to cut prices. Because right now, average hourly earnings, you see that it's causing some inflationary pressure. But right now, businesses think that people can afford higher prices, but we know they can't. When we take a look at average hourly earnings of production non-supervisory employees against the consumer price index, you can see a great relationship here. Look in the 70s to see wages rose and inflation rose. That's what you really want to see happen. But right now, what we're seeing from service providers is saying, look, we can't afford to maintain these wages, and our employees want to make more money, so we have to raise prices. But the problem is when prices rise faster than wages, you go right into a recession. It happened here, right? The global financial crisis happened again, the dot-com bubble happened in the 1991 recession, and there's very good reason why, because when you look at average weekly hours, what you see is that employees are asking for higher wages because their hours hours are getting cut, and you see they get cut right into the 91 recession. They get cut right into the dot-com bubble. They get cut right into the global financial crisis, and they get cut now, and there's a big decline sitting here. So you think back to these German workers, and what are they facing? A decline in new orders. They're seeing the backlogs go away. So what are their bosses doing? They're cutting hours, and they're cutting jobs, and it's going to backfeed right into the economy. And so what are the Germans doing about this? Well, they're asking for a big change as Scholz leaves Germans with the worst economic blues in a generation. And the polls are correct about the drop-off from Scholz's 2021 victory, and the numbers have barely moved during the 3-month campaign. The Social Democrats will face a bigger loss under any German leader since the Federal Republic was set up in 1949. And he's now being labeled as a sick man of Europe. And yes, when people hit the unemployment line, they demand a change. The problem is there's going to be change spreading all over Europe, all over the world, because what's happening in Germany, my friends, is we're seeing stagflation. Prices are rising, inventories are building, and people are losing their job. We see that happen in the UK. We're seeing signs of that happen here in the US. And as you're about to see it spreading all across Europe, we already know it's happening in Asia. And this tells us what's happening in Germany is a warning sign to the world. Let's take a look at the French services PMI, now at a 17-month low. Remember, service sector was supposed to soar here. It's now at 44.5, clearly in a contraction. Meanwhile, the manufacturing sector, I love this, it says a 9-month high, even though it's still contracting at 45.5, meaning more jobs are going to be lost. A survey response in both sectors frequently cited lower client demand in February. Low footfall, weak confidence in outlook, and investment reticence also dampened sales as anecdotal evidence suggested. So this is very clear. What we see, when people lose confidence, they spend less. And just last week, what did we get? The University of Michigan Consumer Confidence Survey. What it said, overall confidence down, current conditions down, future expectations down, and not by a little bit, by a lot. And when confidence goes, spending follows. As we now look at consumer sentiment, this shown in red from the University of Michigan against advanced retail sales. Again, that is inflation adjusted. What do we see back in the mid-90s? Confidence goes down, and what happens? Real retail sales goes down with it. You see it happen once again right here going to the dot-com bubble, happens going to the global financial crisis. You see this big plunge in confidence, and next thing you know, real retail sales right into a contraction. You see it as we almost headed into global recession around 2015, and now we're going to expect to see it again. In fact, Walmart was just saying, look, we did not think that things were going to turn out the way we did. We thought consumers were going to come out and spend, and now our outlook for their spending in the next 6 months has gotten worse, and you can see why. Because when consumers start to see their confidence fall, it's because of their incomes and their confidence in the labor market. What we're seeing from University of Michigan is consumers are saying, we've got to cut our spending here because I'm afraid I'm going to lose my job. You look at what's happening in Germany. You look at what's happening in France. Confidence is plunging, and it's all to do with the labor market and lack of demand. Because February's more rapid decline in new business placed a greater onus on existing work to support activity. Backlogged orders, here we go again, were reduced sharply and at the swiftest pace in 15 months. French private sector companies lowered their employment levels midway through the first quarter, and the decline in staffing numbers was the steepest since August of 2020. So again, we look back to Germany and that plateau that everyone was hoping to happen. Absolutely no evidence. It's just a plateau on another big leg down. Now France putting out the same warning as Germany because French businesses were challenged by intensified cost pressures in February as prices increased at the strongest rate since late August, with both manufacturers and service firms reporting marked rises in their operating expenses, meaning stagflation coming to France as well. But what about the broad Eurozone? Well, things there are also getting worse. It's not just France, it's not just Germany. Look at the broad Eurozone services PMI. It now in just a very tiny expansion at 50.7, now hitting a 3-month low, suggesting that the manufacturing sector that's still contracting, now at 47.3, although better than January, is leading the services sector lower. And what do we see here? New orders decreased for the broad Eurozone for the 9th month in a row. The pace of decline was modest, but sharper than seen in January. Services new business fell for the first time in 3 months, meaning we're going to see more people hit the unemployment line all across Europe. We're seeing it again in the UK. We're going to see it in the US. And after having neared stabilization in the previous survey, here we go. Again, we talk about this hope of stabilization. And then look what happens in France. Employment fell at a faster pace in February as a marked reduction in manufacturing workforce numbers outweighed the slight rise in services employment. So here again, we see full evidence of stagflation spreading all across the world, and it's only going to get worse for Europe because tariffs are coming. And the EU sees a $28 billion hit from Trump's steel and aluminum tariffs, and if you don't think that's going to put people out of work, it is, because the amount of goods which the EU assesses will include derivative products as well would be about 4 times larger than the last time Trump targeted the bloc's metal sector. And so what we're seeing all across the Eurozone, centered in Germany and in France, we're seeing their economy slow, the manufacturing sector in a clear decline. We're seeing new orders not sustainable to their workforce. We're seeing backlogs get cleared through, prices rising, evidence of stagflation. And when these tariffs hit, you're going to watch more layoffs are coming, and in a big way. But just because that's going to hit the global economy doesn't mean you can't be making money. Our momentum trading is changing the game. Again, let's take a look at that Brazil trade. They're one of the hottest trades right now, this identified by Bank of America, and despite Friday's big decline in the market, we're still up a whopping 8.02%. And again, we give our subscribers clear signals. We tell them when to buy, where to put their stop losses, and we give them updates as we go through every trade. But look at this. Here's the big win. As everyone got clobbered on Friday, we've got a 91% win rate when we trade the machines, 92% win rate trading momentum, all on our current positions. So while everyone else is panicking on Friday, our subscribers were watching their accounts go up. Let's take a look, because when it comes to trading momentum, a lot of people look for these oversold conditions on the charts and they think, well, that's where you're supposed to buy. And yes, sometimes you get a little bit of a pop, but if you're in a big downtrend, look what happens. If you bought here, you lost money. You bought here, you lost money. You bought down here, you lost money. But you bought here, what we told our subscribers to. This is our Brazil trade. Look, they're making money. And you see the 6-month volume profile, there's support here. So if prices pull back here, it looks like they could take off for another big leg higher. Now, we give you the report every day, but if you're not into all that data, here's the best part. You don't need to be, because we break it down. We give you all the notes on all the trades we think you should take, but you get the daily report. You get the tradable signals. I tell you specifically, these are the trades. I tell you when to buy them. I give you the stop loss levels, and we back tested this, and we know our reports work. Again, we give you those risk control levels. We update them on a regular basis, a full weekly update on the weekend of all our trades. Not to mention, I disclose how I'm trading. Yes, I use my own reports to trade. Plus, we include a 30-day free trial. And why do we do that? Because I'm so confident. Not only am I making money trading on my own reports, we have subscribers making a bundle, and we believe you can too. Jump in, grab a trade, start making money. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.